I'm Charlotte McLeod with the Investing News Network, and here today with me is Ian Ball, President and CEO of Abitibi Royalties. Thank you so much for being here online with me today. Great to talk to you.
Thank you, Charlotte, for having us today.
All right, we're going to jump right into our questions. And your company, of course, is a royalty company. And I want to start off by talking about the trend we've seen of more and more of these types of companies popping up in the last maybe year or two. What do you think is driving that trend is where I want to begin.
Well, you're quite correct. If you go back 40 years, it was essentially one royalty company in the mineral space, being Franco-Nevada. And during the past 2 months, you've seen 3 or 4 separate IPOs of new royalty companies entering into the space. So, why is that? I think it's because if you look at historically, the royalty companies have delivered a better return to the shareholders than the producers have. So more people are obviously interested in that, looking at the success of the model and trying to replicate it by creating new royalty companies. What does that mean in terms of, for ourselves? Well, obviously, these are smaller royalty companies that are entering into the space, not too dissimilar from Abitibi. We started in 2011. But what's interesting is that, from our perspective, a lot of the royalty companies that are what I would call small to medium size have stated their objective, which is to continue to grow by acquiring additional royalties. And for most of them, they're going to have to do that by issuing new shares. And I guess my belief has always been when you issue stock to grow, it's a bit ironic because you're actually selling a part of your existing asset to strangers. So you're selling to grow. So it's a bit of a catch-22. Our view has been we don't want to enter into that space. We've stated time and time again that we want to grow organically, through our current royalty portfolio, through the cash flow that we're generating. And so we've been looking to do that multiple ways. So although there's been a lot of new entrants into the market, we really don't see them as direct competitors because we're pretty happy with the portfolio that we currently hold.
So for you, you've drawn a line between what you're doing, what the new entrants are doing. And so for your business, it's really you're going to be continuing on your path.
Yeah, if you look at where the success in this industry has come from, it's through exploration. Typically, it hasn't come through acquisitions. And it's not to say you shouldn't be looking, and there's certainly opportunities where 2 companies put together are stronger, but usually that's in the minority. So although exploration is very high risk, that is what created Franco-Nevada into what it ultimately became. It was the success at Gold Strike in Nevada. So I prefer the exploration model, investing in early stage. And we've seen that at Canadian Malartic, where we have our main royalty. That has gone from a single drill hole to what is projecting to be a very large underground mine in a reasonably short period of time. So we're going to stay in that part of the spectrum going forward, as well as, we've been very, very vocal about not issuing shares. And so we don't issue shares, we buy back our shares, and I continue to invest all my after-tax income into the shares of the company. And that's why we have the smallest share count of any mining company in the world. So we're going to stick to our model. We like what we see at Canadian Malartic as well as our other portfolio. And, we're just going to continue on our own path. But, there will be increased competition. We're just not really sure how much it's going to impact, where we are on the scale.
All right. Now, for investors who are looking at this new landscape and selection of royalty and streaming companies that are out there, what would your advice be in terms of evaluating them? What are the metrics that people should be looking at? Because I think people do have an idea of what to look at for a mining company, but of course, this is very different.
Right. Well, I think it depends on the type of investor. Different royalty companies are suited to different types of investors. I think if you are looking for, liquidity, there's other royalty companies out there that trade a lot better. So, you want to be able to get in and out of that stock. Maybe you are interested in a particular management team or one that is focused on acquisition versus organic growth. For myself, when I look at a royalty company, I look at, what is the value proposition based on what they have today? And why can it get better in the future? So do they have the right geology? Do they have the right operators? How much are those operators spending on the asset to ensure that you can turn those ounces into cash flow? How is management, I think you have to look at it, how is management respecting the shareholders? Are they issuing 5 to 10% of their stock in the form of stock options or restricted share units each year? Because that's something that kind of goes below the radar. It's a huge tax and drag on a share price. So I think, there's a lot of opportunity out there, and it's all depending upon, each individual investor I find is quite unique. And I think there's a number of royalty companies out there that kind of now suit that purpose. We're trying to target investors who are more long-term oriented and see themselves as partner in the business.
Maybe you can give me a sense of what the company has going on right at this moment. I know it's been an interesting year with COVID-19, although I do remember from previous conversations that Abitibi wasn't overly affected by the pandemic.
No, you are quite correct. We're generating royalty income from the Canadian Malartic mine, which is in Quebec, Canada, and that was shut down for 3 to 4 weeks last year. But since then, the operation has resumed. In terms of what else has been happening with us, the most important milestone was that the underground mine at Canadian Malartic was approved for construction. And if you look at what Agnico Eagle and Yamana, they're looking to spend approximately $1.7 billion Canadian on the underground infrastructure. So, in the whole underground, so not just our royalty, but the entire underground situation there is expected to be the largest underground gold mine in Canada. And, initially it has a 13-year mine life with only half the resource base being included in the initial study. So work on the ramps and on the surface facilities for the shaft is already underway. So this is an asset that I believe could be operating for decades to come. And I think we're in the very early stages of the exploration there. So it's kind of rare to see a company of our size having a royalty on this big of an operation with operators that are that strong, because you don't see major mining companies selling royalties anymore.
Right. So I think that gives us a pretty good idea of what's going on in the royalty space right now. What other trends are you seeing in the mining industry as a whole that maybe investors could be missing, or you think they should be paying attention to?
Well, I think, a common theme you've been hearing now for several years is how do you attract the generalist investor to the mining companies or royalty companies? And I guess the first question you have to ask yourself, if you are a generalist investor, why would you even invest? If you look back to 1990, the share prices of most of the major mining companies are either at the same level or lower than what they are today. And the gold price has gone up by 400%. So if you're a generalist, you didn't do very well versus the gold price versus the Dow. And I think the question is, why is that? And, one of the few companies that's been able to execute and grow their share price over that time period was Agnico Eagle, and they've done a very good job being able to acquire and grow through that, but they're probably the only one that's been able to successfully grow through acquisition. And so I think when we look at how do you attract a generalist investor, I think we have to remember we're competing against bank stocks in Canada, that pay big dividends. They've been performing very, very well recently. We're going up against tech stocks. And so you have to show why I think we can get a higher return on capital than other industries. I think that's what it comes down to. You can't just hope that you're going to attract a generalist. You've got to put up competitive rates of return against other industries. And for the most part, over long periods of time, we have failed to do that.
And do you think the situation has changed now or is currently changing?
That is a tough one to know. There's a lot of talk about it changing, but how do you do that? And that's a very tough question. I give you an example where at Abitibi, we don't issue stock options. So, that's one way you're trying to make sure management is aligned with the investors. So it's very easy to say you want to attract a generalist investor and you want to do the right thing. I think one of the things that we could do as an industry is looking at the overall strategies. And I think there's a lot of opportunities, particularly for the senior mining companies, to make smart acquisitions around their existing infrastructure. So rather than building new milling facilities, I think there's a lot of deposits among the junior resource base that could be developed at lower cost than building new mines. So how do you better leverage your current asset base? I think that would go a long way to driving better rates of return than building brand new mines in greenfield types operations.
Right. And so that influx of generalist investor attention that we see people talk about, do you actually see that coming in the next months or years?
Not unless the rates of return start to improve. I think general investors will only look at this if the rates start to improve on the mining operations or the gold price picks up. But as a manager of a gold company, I don't think you can bet. You don't want the gold price being the thing that has to save you to attract the generalist investor. I think it should always be your job to do the best for your shareholders, not just so much for the generalists, but for every shareholder you currently have. And how do you do that? I said it's like treating your investors like they're partners in the business. And I think it's a constant focus on returns. And I think as an industry, we could do actually a better job of leveraging, like I said, the current assets that we have by continually believing in the assets that we already own, maximizing every sense of value through that. And, I think some companies will get there. And I said, if you look at Agnico Eagle, I think it's done a fabulous job of reaching a broader community than just the gold investor. Franco-Nevada has been another one that's done that. But why has that been the case? It's because their share price have performed over long periods of time. They've been very smart with their share issuances and how they raise capital. So I think those are two companies that as a royalty company or producer, we should look to try to emulate.
All right, I want to take a moment to talk about gold, which we usually touch on when we're speaking. I know that some people are feeling concerned about the price level that it's at right now. What do you see going on with gold?
Well, I have to admit, if you look a couple of days ago, gold price was flat year over year. And you say, well, how is that possible? They've printed all of this money. And I heard a very good statistic that in 2020, of all the US dollars that exist in the world, so the US dollar was created, give or take, around the time of the US Civil War. So you have, 1870 roughly, and 20% of all US dollars were created in 2020. And the gold price is flat. And you say, well, why is that? I wish I had a better answer for you, but I don't. And I think gold should be trading higher. If you look at the US deficit that they've been running, you look at the money supply that's been created versus the amount of new gold that's been produced over the past year, you can make a very strong argument that gold should be trading somewhere between $1,900 and $2,400 an ounce. But where I think it should be trading versus where it actually will are two different things. But I think there's some very good fundamental reasons why you could say gold is below where it should be right now. And you can chalk that up to Bitcoin. You can say, well, it's because the US rates have been going up. The US dollar, has been stronger, I should say, over the past, month and a half. But I think long term, you can't keep gold down, and it will go to, its value, because gold tends to overshoot, and it tends both sides, to the upside and to the downside. And it seems like $1,700, $1,600 is a pretty good floor for the price of gold right now. So I suspect in a year's time we'll be higher than where we are today.
Right. And I know we've spoken about this before, but maybe you could give us a quick idea of some of those fundamentals that you see backing gold at the moment.
Well, I think the number one is you look at what governments are doing around the world right now, having personally worked in Argentina, who has 40% inflation, it's staggering to see what happens on payday. Everyone gets paid in Argentinian pesos, and they immediately go buy gold, US dollars, or real estate because they want to get rid of those pesos. And I think right now, governments around the world are stealing from their citizens at the rate they're depreciating the dollars. What's happening, though, is that every country in the world is doing it, so people don't really notice it's happening. If it was just one country that was doing it, then you could feel that their currency would be going down a lot quicker than other countries. But the fact that everybody is doing it, I think the number one, though, is money supply. And if you're creating money at 10 to 20% a year, and the amount of new gold hitting the market every year is 2%, I think it's a very good case why people should have gold in their portfolio, because gold is money. Gold's been money for 7,000 years. And I know people are making a case for Bitcoin, but due to the volatility and the fact it doesn't have a very long track record, I would be willing to, if I had to buy an asset and hold it for the next 50 years, I would pick gold, because gold is money. It will retain its value. And I think that's going to be the big driver, because I don't see, now that the governments have been given the clearance to keep printing money and run these large budget deficits, it's very hard to take your foot off the accelerator.
Well, I think that's a good, solid point to end on, but I will ask if you have anything that you would want to add about either the gold price or what's going on at Abitibi right now.
No, I think I think that kind of we've hit all facets of it. So I would just say, if you are an investor in the gold sector, I know that the last couple of months have been a little trying, but the gold price does move in cycles, and the gold price in the industry will get better from here. I'm very confident in that. And we have a lot of bright people in this industry that I think are doing their best. And sometimes the gold price runs against you for a little bit. But I think that based on everything you're seeing in the world, I think better days are ahead for the gold mining sector.
Okay, well, I think that is definitely a great place to end on. Thank you so much for being here to talk with me today.
Thank you for having us today.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Ian Ball with Abitibi Royalties.